Something fundamental has shifted in the precious metals market. And if you own gold or silver, or if you've been watching from the sidelines, what happens in the coming months will matter more than most people realize. This isn't about panic. It's not about predictions. It's about understanding a moment in financial history that could define portfolios for years to come. Right now, there's significant volatility in gold and silver prices. Some analysts are warning of a collapse. Others are calling for new highs. The noise is deafening. But what's actually happening beneath the surface has less to do with daily price movements and everything to do with forces that have been building for years. I'm speaking to you today not as someone trying to sell you certainty in an uncertain world, but as someone who believes that understanding how markets work, how cycles unfold, and how disciplined investors think is more valuable than any single prediction. If you hold precious metals, you're probably wondering whether you made the right decision. If you don't, you're probably wondering if this is opportunity or trap. Both questions deserve serious answers, and that's what we'll explore together over the next 25 minutes. The truth is, most people approach gold and silver with emotion rather than understanding. They buy at tops out of fear. They sell at bottoms out of panic. They follow personalities rather than studying principles. And in doing so, they turn what could be a strategic asset into a source of stress and loss. Today, we're going to change that approach. We're going to look at what's actually driving these markets, what history teaches us about similar moments, and how thoughtful investors navigate uncertainty without losing their discipline or their capital. Let's start with what we know. Recent weeks have seen notable pressure on precious metals prices. Gold, after reaching significant highs, has experienced correction. Silver, always more volatile than gold, has seen even sharper movements. And across social media, YouTube channels, and financial commentary, the debate has intensified. Some respected voices in the precious metals community have issued warnings. They're pointing to technical patterns, market structures, and sentiment indicators that suggest caution. They're not necessarily saying collapse is certain, but they are saying that risk has increased. At the same time, the fundamental reasons people originally turned to gold and silver haven't disappeared. Government debt continues to expand. Central banks continue to navigate between inflation and recession. Currency debasement remains a structural reality. Geopolitical tensions persist. None of these underlying factors have resolved. So we have a contradiction. The fundamental case for precious metals, protection against currency devaluation, inflation hedge, portfolio diversification, remains intact. But the price action suggests something different is happening in the short term. This disconnect is what creates confusion, and confusion is what creates poor decisions. Understanding this moment requires understanding something crucial about markets. Price doesn't always reflect fundamentals immediately. Markets move based on positioning, sentiment, liquidity, technical factors, and timing. Sometimes price leads fundamentals. Sometimes fundamentals lead price. The gap between the two is where fortunes are made and lost. Right now, we're in one of those gaps. And how you navigate it depends entirely on whether you understand what you own and why you own it. Let's step back and look at the bigger picture, because without context, price movements are just noise. We're living through one of the most unusual monetary periods in modern history. Over the past 15 years, central banks around the world have expanded their balance sheets to unprecedented levels. They've kept interest rates artificially low for longer than any previous cycle. They've intervened in markets in ways that would have been unthinkable to previous generations of bankers. This created a world where almost every asset class became distorted. Stocks traded at valuations that assumed perpetual low rates. Bonds offered returns that barely covered inflation. Real estate prices disconnected from income fundamentals. And investors, searching for yield in a zero-rate world, took risks they didn't fully understand. Then came the inflation surge of recent years. Central banks were forced to raise rates faster than they had in decades. This created pressure across the entire financial system. Assets that thrived in a low-rate environment suddenly faced headwinds. Credit conditions tightened. Market volatility increased. Gold and silver, as real assets with no counterparty risk, initially responded positively. They're supposed to perform well when currency purchasing power is threatened. And for a time, they did exactly that. But something else happened simultaneously. As rates rose, the opportunity cost of holding non-yielding assets like gold increased. Investors could suddenly earn meaningful returns in treasury bills or money market funds. The capital that might have flowed into precious metals found alternatives. At the same time, the strong dollar became a headwind. Since precious metals are priced in dollars globally, a rising dollar makes them more expensive for international buyers. This reduces demand and creates technical pressure on price. So we have competing forces. Fundamental factors suggest metals should hold value or increase, but technical and positioning factors create downward pressure. This isn't unusual. Markets are always balancing multiple forces, but it does create the conditions for volatility and confusion. Understanding this context is essential because it explains why both the bulls and bears can point to valid data to support their view. Both are looking at real factors. They're just emphasizing different time frames and different mechanisms. Here's what most investors get wrong about precious metals. They treat them like stocks. They expect them to go up steadily. They check prices daily. They celebrate when prices rise and despair when prices fall. They think in terms of short-term gains rather than long-term insurance. This is a fundamental category error. Gold and silver aren't growth investments. They're not supposed to make you rich quickly. They're not tech stocks or cryptocurrency. They serve a different purpose entirely in a portfolio. Precious metals are insurance against monetary instability. They're diversification against paper asset risk. They're a store of value across long periods of time. They're most valuable precisely when other things are going wrong. When you understand this, short-term price movements become less emotionally charged. You're not betting on gold going up next month. You're holding a position in case the monetary system experiences stress over the next decade. But because most people don't understand this distinction, they make two critical mistakes. First, they buy at exactly the wrong time, when everyone is excited and prices have already run. Second, they sell at exactly the wrong time, when prices correct and sentiment turns negative. This is why the average investor in precious metals dramatically underperforms the actual metals themselves. The asset might return 5% annually over a decade, but the average investor loses money because they time their entries and exits based on emotion rather than strategy. There's another misunderstanding worth addressing. Many people believe precious metals should move in perfect correlation with inflation or debt levels. When they see gold not responding immediately to some monetary development, they assume the thesis is broken. But markets don't work that way. There are always lags, countertrends, and periods where technical factors override fundamentals. The relationship between gold and monetary instability plays out over years and decades, not weeks and months. If you bought gold in 1971, when Nixon closed the gold window, you would have endured a massive decline in the late 1970s before the ultimate explosion higher. If you bought in 1980 at the peak, you waited 20 years for a new high. If you bought in 2011 at the peak, you endured nearly a decade of pain. Timing matters. Understanding cycles matters. But more than anything, understanding what you own and why you own it matters most. Let's talk about cycles, because nothing in markets moves in a straight line. Every asset class experiences periods of accumulation, markup, distribution, and decline. Precious metals are no exception. Looking back at gold's history over the past 50 years reveals clear patterns. There have been three major bull markets in gold. The first ran from 1971 to 1980, taking gold from $35 to over $800. The second ran from 2001 to 2011, taking gold from $250 to $1,900. The third began in 2016 and has taken gold from just over $1,000 to recent highs above $2,000. Between these bull markets were brutal bear markets. From 1980 to 2001, gold lost 2/3 of its value and became a widely mocked investment. From 2011 to 2016, gold fell 45%, and precious metals investors were ridiculed as doomsayers. This pattern teaches us something critical. Precious metals move in multi-year cycles driven by changes in monetary conditions, real interest rates, inflation expectations, and currency confidence. Within those cycles, there are significant corrections that shake out weak hands and test conviction. The question everyone wants answered is where we are in the current cycle. Is this a correction within an ongoing bull market, or is this the beginning of a new bear market like we saw after 1980 or 2011? Honest analysts will tell you no one knows with certainty. But we can look at conditions that characterized previous cycle turning points and see if they're present today. Major tops in precious metals typically occur when inflation has peaked, interest rates have risen dramatically, economic conditions are improving, and sentiment among retail investors reaches euphoria. Think 1980 when inflation hit 15% but was beginning to roll over. Think 2011 when gold had become front-page news and commercials urged people to sell their gold jewelry. Do we have those conditions today? Some are present, some aren't. Inflation has cooled from its peak, but remains above central bank targets. Interest rates are elevated, but not at the extreme levels of previous peaks. Sentiment among precious metals investors is mixed, but nowhere near the euphoria of past tops. Meanwhile, the fundamental conditions that support precious metals remain in place. Government debt as a percentage of GDP is higher than ever. Central banks face a persistent dilemma between fighting inflation and supporting economies. Geopolitical tensions are elevated. Trust in institutions continues to decline. This suggests we may be in a correction within an ongoing bull market rather than at a major top. But, and this is crucial, it doesn't guarantee that outcome. Markets can remain irrational longer than investors can remain solvent, as the saying goes. Understanding what drives price in the short term requires understanding investor psychology and market structure. This is where many fundamental analysts fail. They focus only on economic conditions and ignore the human behavior that actually moves prices day to day. Right now, there's significant uncertainty in the precious metals community. Some prominent voices who were very bullish have turned cautious. Some technical analysts are pointing to warning signals in chart patterns and market breadth. Some are noting excessive optimism in survey data that often marks short-term tops. When respected analysts issue warnings, it creates a cascade effect. Their followers reduce positions. The selling creates downward price pressure. Others see the price decline and question their own thesis. More selling follows. Technical stop losses get triggered, and what began as a healthy correction can accelerate into something more painful. This is how markets operate. They're reflexive systems, where price movements influence sentiment, which influences more price movements. Understanding this doesn't tell you exactly what will happen next, but it does help you understand why volatility increases during uncertain periods. There's also the reality of leverage in metals markets. Many investors don't own physical metal. They own futures contracts, options, or leveraged ETFs. These instruments can amplify both gains and losses. When prices move against leveraged positions, forced liquidation occurs, creating additional downward pressure. The metals markets are also subject to manipulation concerns, whether by large commercial banks, algorithmic trading systems, or official sector intervention. While the extent and impact of such manipulation is debated, the perception itself influences investor behavior and can create self-fulfilling price movements. All of this creates an environment where short-term price action can diverge significantly from long-term fundamentals. An asset can be fundamentally sound and still experience painful corrections because of positioning, sentiment, and technical factors. This is why experienced investors focus on position sizing rather than prediction. They recognize that being right eventually doesn't help if you're forced out of positions during interim volatility. They manage risk first and return second. If you currently own gold or silver, you're probably experiencing some discomfort. Maybe you bought recently and are now underwater. Maybe you bought years ago and are watching profits erode. Maybe you've held through multiple cycles and are wondering if this time is different. Let me offer you some perspective that has nothing to do with predictions and everything to do with process. First, ask yourself why you bought. If you bought precious metals as insurance against monetary instability, then short-term price movements are irrelevant to your thesis. Insurance doesn't become worthless because you haven't filed a claim yet. You hold it because of what could happen, not what has happened. If you bought because you thought prices would go up quickly and make you wealthy, then you bought for the wrong reasons. That's speculation, not investment. And speculation in assets you don't understand is how capital gets destroyed. Second, assess your position size. If your precious metals holdings are keeping you awake at night, they're probably too large, relative to your total portfolio and risk tolerance. The appropriate allocation to gold and silver for most people is somewhere between 5 and 20% of investable assets. At that level, even significant price declines don't threaten your financial well-being. If you've allocated more than that, especially if you've used leverage or hold positions in vehicles you don't fully understand, then you may need to reduce exposure regardless of your long-term view. Protecting capital is more important than being proven right. Third, understand your time horizon. If you need this money in the next year, you should never have put it in precious metals. These assets can remain volatile and range-bound for extended periods. They're suitable for long-term holdings, not short-term trading unless you have specific expertise and risk management systems. If your time horizon is 5 to 10 years or longer, then current price action is noise. You're holding these assets because you believe monetary stress is more likely than not over that time frame, and you want protection regardless of interim volatility. Fourth, resist the urge to average down without clear thinking. Many investors see lower prices and automatically buy more, thinking they're getting a bargain. But averaging down only makes sense if your original thesis remains intact and you have capital that won't be needed for other purposes. If the fundamental case has changed, if inflation has been permanently solved, if debt levels are shrinking, if central banks have found a way to normalize without consequences, then averaging down is throwing good money after bad. You need to honestly assess whether conditions support your position or undermine it. Finally, ignore most of what you read online. Social media and YouTube have created echo chambers where confirmation bias runs wild. Bulls surround themselves with bullish voices. Bears surround themselves with bearish voices. Everyone can find support for their position. This creates false confidence and prevents honest reassessment. If you're watching this situation from the sidelines, you might be feeling relief that you avoided the recent volatility. Or you might be wondering if declining prices represent opportunity. Both reactions are understandable. Neither should lead to immediate action. Here's what you need to understand. Precious metals are not essential holdings for everyone. They serve a specific purpose in a portfolio: protection against monetary instability and diversification away from paper assets. If you don't believe those risks are significant, or if you have other ways of managing them, then precious metals may not belong in your portfolio at all. But if you do believe that government debt levels, central bank policy errors, currency debasement, and geopolitical instability are meaningful risks over the next decade, then having some exposure to precious metals is logical. The question is when and how to establish that exposure. Trying to time the perfect entry is a fool's errand. No one can predict the exact bottom. Markets don't ring a bell when it's safe to buy. By the time you're certain the coast is clear, prices have usually already moved significantly higher. The better approach is to build positions gradually during periods of weakness if you've decided precious metals deserve a place in your portfolio. This means buying when sentiment is poor and prices are declining, exactly when it feels most uncomfortable to do so. But this only works if you're buying amounts you can afford to see decline further. If you put in 20% of your portfolio at once and prices drop another 20%, you'll likely panic and sell at the worst possible time. If you allocate 2% and prices drop 20%, you can calmly add another 2%. This is called dollar cost averaging, and while it doesn't guarantee the best entry price, it does protect you from the worst psychological outcomes. You're systematically building a position without trying to outsmart the market. You also need to decide between physical metals, ETFs, mining stocks, or other vehicles. Each has trade-offs. Physical metal has no counterparty risk, but involves storage and liquidity considerations. ETFs offer convenience, but depend on institutional structures. Mining stocks provide leverage, but come with company-specific risks. Most importantly, don't buy precious metals with money you'll need in the near term. These assets can remain volatile and underperform for extended periods. They're portfolio insurance, not get-rich-quick trades. If you might need the capital for a home purchase, medical expenses, or other life events within 3 years, keep it in more stable, liquid vehicles. Let's talk about mistakes to avoid. Because in volatile markets, what you don't do matters as much as what you do. Don't panic sell if you're holding and prices decline further. Selling after significant declines locks in losses and ensures you won't benefit if recovery occurs. Unless your fundamental thesis has changed or you discover you were overallocated, selling into weakness is usually wrong. Don't chase predictions from personalities online. The internet has created a class of financial entertainers who make bold calls to attract attention. Some will be right occasionally, none are right consistently. Building your financial future around someone else's predictions is abdicating responsibility for your own education and decision-making. Don't use leverage to try to accelerate gains. Borrowing money to buy precious metals or using instruments like futures and options without expertise is how serious financial damage occurs. These markets are volatile enough without amplifying your exposure to movements you can't control. Don't ignore the rest of your financial life. Precious metals are one component of a complete financial plan. They don't replace emergency funds, insurance, debt management, retirement savings, or income generation. Some people become so focused on metals that they neglect other crucial areas. This is a recipe for overall financial failure, even if your metals thesis proves correct. Don't assume this time is different. Every market cycle produces a narrative that this time is unique and old rules don't apply. Sometimes conditions do change, but more often, the fundamentals of market behavior, investor psychology, and economic cycles remain consistent across generations. Humility in the face of market history is wisdom. Don't follow the crowd. By the time everyone agrees on a market direction, that move is usually exhausted. Precious metals work best as a contrarian holding, bought when unpopular, held through uncertainty, sold when they become mainstream excitement. And finally, don't stop learning. Markets are complex adaptive systems that evolve constantly. What worked in past cycles may not work in future cycles. Your job as an investor is to continuously update your understanding while remaining grounded in timeless principles. We've covered a lot of ground today. Let's bring it together. Precious metals are experiencing volatility and uncertainty. Some respected voices are issuing warnings. Price action has created doubt among holders and confusion among observers. This is uncomfortable. But discomfort is part of investing in assets that serve as insurance against monetary instability. The fundamental case for holding some precious metals as portfolio protection hasn't disappeared. Government debt remains elevated. Central banks still face difficult choices. Currency debasement continues. Geopolitical tensions persist. These are the conditions that have always supported precious metals over long periods. But fundamentals don't prevent corrections, volatility, or even extended periods of underperformance. Markets move based on positioning, sentiment, liquidity, and technical factors in the short term. The gap between short-term price and long-term value is where discipline is tested. If you hold precious metals, your task is to understand why you hold them and ensure your position size matches your conviction and time horizon. If you don't hold them, your task is to decide whether the insurance they provide is appropriate for your situation and risk profile. What matters most is not predicting what happens next. No one knows with certainty where prices will be in 6 months or a year. What matters is understanding the role these assets play, managing position size appropriately, maintaining emotional discipline, and thinking in terms of years rather than weeks. The investors who do well in precious metals are not the ones who time entries and exits perfectly. They're the ones who establish reasonable positions based on a long-term thesis, ignore short-term noise, and allow time for that thesis to play out. Financial markets are always uncertain. There's always a crisis, always a warning, always a reason to panic. The investors who build wealth over time are the ones who can distinguish meaningful signals from noise, who can maintain discipline when others are emotional, and who understand that preparation and process matter more than prediction. Thank you for investing your time today. Stay informed, stay disciplined, and remember that understanding cycles and managing risk is more valuable than any single prediction about where prices go next.